Hey, good morning, everybody. Hope everybody had a good week. Back at it this week. Hot weather, 80. Well, actually, it's only 88 degrees, but it was hot as heck yesterday. My wife and I, we just got back from Flagstaff. It was nice, 75 degrees, and it was returning back to the hot weather. But hey, back to the grind. A lot of good things that are coming up this last week as far as conforming loan limits, housing demand, home prices, and unfortunately, interest rates really haven't come down as far as what we want it to be. But hey, I think we're headed in the right direction. And I'm actually just getting my stuff set up. I apologize. So with that, okay, so just jumping right into interest rates. So interest rates, we took a hit last week, actually a pretty big hit last week as far as interest rates. Conventional 720 FICO, 5% down. We are at 6.235, APR 6.737. FHA FICO 6.5% down. We're at 5.5% and 6.554 as far as APR, so 5.5% on FHA, and then VA FICO 680 FICO, no 0% down. We're at 5.231. 5.473 APR. So what does this mean for us as far as rates? Where do we go from here? Uncharted territory. We had the pandemic, and now we have inflation versus recession. That's going to be the old tug of war that we have. Inflation in July was down. We're waiting for the inflation report for August to see if inflation is coming down, it came back up, or stayed even. And so that's going to continue to battle with us as far as our housing market and interest rates. Obviously, a recession is going to be good for the housing market. Recession is going to be good for interest rates. Obviously, I don't want a recession because it's just in general, it's just not good for everybody as far as an economy. But in my opinion, what we do need is some type of correction. And specifically to what I do, housing, the correction we need is in affordability. Affordability is just off the charts, right? Even when interest rates were at 2.99% or 3.125, affordability was out of, or how the affordable housing was out of reach for a lot of people. And so we really need some type of correction to our affordability issue with housing. And a recession, or what the feds are doing right now in a recession or a correction. Let's use the word correction. I want to use recession. A correction to our housing market is something that we really need because we need more affordable housing. We're starting to see that. I mean, housing is sitting on the market for 40, 60 days. People are dropping home prices $50,000, $80,000, $100,000 as far as that. And we, again, arguably are in an even market as far as a balanced market, as far as demand and supply. But again, we need more, right? We need more affordable housing. And then once we get through the rest of this year, we get into next year, as far as where the economy is going, I think that's going to create a little bit more demand. But we need to be careful because if we have too much demand, that means that all this supply that we have is going to get gobbled up quickly. And then we're going to fall back into the same issue that we had in 2020, 2021, right? But you have to remember this, the last 10 years, the last decade, we have been undersupplied, okay? Our housing market here in Arizona has been undersupplied. Builders have never in the last 10 years have built at the same pace that they were in 2000s, okay? And as far as resale, there's just been that consistent supply of resale. People moving up to bigger houses because their families are getting bigger. People downgrading because they're empty nesters. They don't need that 4 or 5 bedroom, right? Or obviously just your natural second homes or investment properties. So we've had a consistent amount of resale, existing homes, resale, selling, and builders just building at a good, steady click, right? So we've been in an undersupplied, technically we've been in an undersupplied market, but demand has stayed steady, right? We've just had that even kill of demand and supply. Once demand shot up just a little bit, that's where we have that supply issue. We can't build more houses. We can't so we can build houses, but we can't build them even faster. The last report a couple of weeks ago, builders would have to increase supply 300%, which is not going to happen. So that's just really what we want to look for, is just that correction versus crash. That's the other thing too. People are talking about, okay, are we going to have a huge crash? Is this something, houses are going to lose value, $100,000, this and that? Because I have to understand is that 2008 was totally different. 2008, we didn't have the strict guidelines that we have right now as far as lending. If you could fog a mirror, you could get a house. Now you have to prove your income. We have to verify your income. You have to prove your assets. We have to verify your assets. We have to verify your work history. We have to verify your residence history. The list goes on and on as far as what we need to do to get you approved for a mortgage. So there's stricter guidelines. As far as the secondary market, right? There's the first market as far as what we extend loans to buyers. The secondary market is going to be the investors, Fannie Mae, Freddie Mac, other investors out there. How all those are sold, how all those are regulated. Again, they're a lot tighter, okay, as far as guidelines. They're a lot stricter. As a mortgage company, when we sell a home or sell a mortgage or mortgages on the secondary market, they're scrutinized. They're scrutinized very much. And so if those loans or those mortgages are not up to par, then on the secondary investor, those investors do not buy it and they push it back to the mortgage company, and the mortgage company has to hold that mortgage for the life of the loan. And that could put a lot of companies out of business. So there's strict guidelines, as far as getting qualified for a mortgage and also making sure the mortgage company is doing what they need to be doing. And in that way, we have a good fluid mortgage or housing lending environment. With that, all right, so another big thing that came up last week was the conventional loan limits. Conventional loan limits each year are not announced until November of any given year. So the announcement for the new conforming loan limits is going to happen November of this year, and that will go into effect January 1st of this year. Because of a mortgage, a lot of wholesale investors are starting to announce the new conforming loan limits and allowing me to close loans at the new conforming loan limit. The conforming loan limit, basically going into jumbo, is currently at $647,200. They are anticipating the conforming loan limit to move to $715,000. So any loan at or below $715,000 is not considered a jumbo. Why is that? It's just because the cost of housing, the average cost of houses. Now, why would you want to be in the conforming lending versus jumbo? Jumbos have tighter requirements. They require a higher FICO score. They require a lower debt to income ratio. Some of them require reserves 2 months up to 6 months, depending on which mortgage company you're using. So there's a lot tighter as far as qualifying. They're a lot tighter on the requirements, and they also require at least 10% down. So not being in a jumbo and being in a conforming loan allows you to have a little bit looser requirements. You don't have to put 10% down. You can get away with 5% down as long as you can qualify, or 3% down if you're a first-time home buyer. So this is a calculated risk, because the calculated risk is this. The Federal Housing Finance Authority, or FHFA, they have not announced the new conforming loan limits yet. They're not going to be announced until November of this year. So the calculated risk is this, is that if we start doing loans up to $715,000, and the announcement comes in low, that's the calculated risk. What that means is that those technically are not conforming loans. They're considered jumbo loans, and the mortgage companies out there that have extended loans at the supposed new conforming loan limit at $715,000, they are now opening themselves up to really not being able to sell those loans to Fannie Mae or Freddie Mac, and they're going to have to hold those loans until they can actually get rid of them. Okay, it's not going to cause any issues to your loan if you actually do use a mortgage at the new conforming loan limits and it doesn't really follow through or happen, it's not going to cause anything to you guys. It's actually going to be a benefit to you. So, hey, if there's mortgage companies out there that are allowing you to get a mortgage at $715,000 or the new conforming loan limit, $715,000, then I would take advantage of it. And if it doesn't work out, it's on them, not you. So that's something that came up last week. Just know that that's a good thing for you. It's a calculated risk. It's anticipated. The new limits really have not been announced yet, but there are some wholesale investors that only mortgage brokers have access to. There are some wholesale investors that are allowing you to, get a loan at the anticipated new conforming loan limit. With that, as far as rates, we're going to have to wait and see where rates go from here. Inflation, recession, right? We have a Fed rate coming up, Fed rate hike coming up at the end of this month. I think that we're going to see 0.75% increase because the Feds have announced that they are committed to battling inflation, even if there's economic pain. And we'll probably see another one in December. Depending on how inflation is, that one might be 0.5%, not 0.75%. But I think that the Feds are, they're in the right direction. They're going in the right direction. It's helping inflation. It's obviously helping housing because demand is down. And we'll see where we go from there. So, all right, guys, you have a good week. If you have any questions, please reach out to me or if you're curious if you have getting the best deal possible. Please reach out to me, 480-773-2686, get you pre-qualified in 5 minutes. And as a mortgage broker, again, I don't have the extreme overhead that the big companies have. So the rates that you get are going to be much lower and at minimal fees. So you guys have a good week. Thanks.